Tesla stock is up 32% in 3 months. Google just touched a new all-time high last week. Nvidia, even after pulling back from its peak, is still up over 200% from where it traded 18 months ago. If you look at your brokerage account and you own any of these names, you're probably feeling pretty good right now. But there's a number that Warren Buffett watches more closely than almost any other metric, and that number is sitting at a level it's only touched twice in the last 3 decades. Both times, what followed was brutal. I'm talking about the Buffett Indicator, and right now it's above 200%. That's higher than it was before the dot-com crash. It's higher than it was before the 2008 financial crisis. The only other time it's been this elevated was early 2021, right before the market dropped 25% in 2022. So here's the question I want to answer in this video. Can a handful of mega-cap tech stocks keep carrying the market higher when the entire market is valued at twice the size of the US economy? Or are we sitting on a setup that's far more fragile than the headline numbers suggest? But if that growth doesn't materialize, or if it comes in slower than expected, prices have to reset. And when they reset from levels this high, the drawdowns are not small. We're not talking about a 5 or 10% correction. We're talking about the kind of declines that take years to recover from. Let me give you the historical context because this isn't theoretical. The Buffett Indicator first spiked above 140% in the late 1990s. By March of 2000, it had pushed past 150%. The Nasdaq peaked that same month and then proceeded to lose 78% of its value over the next 2.5 years. Blue-chip tech companies that everyone said were unstoppable got cut in half, then cut in half again. Cisco, which was the most valuable company in the world at one point, dropped from a market cap of $555 billion to under $100 billion. It took 24 years for that stock to get back to its 2000 peak. 24 years, an entire generation of investing. Fast forward to 2007. The Buffett Indicator was sitting around 135%, not as high as the dot-com peak, but still elevated. Then the financial crisis hit. The market dropped 57% from peak to trough. It took 4 years just to get back to break even. Now, that crash was driven by a credit crisis and a housing collapse, not just valuation. But the point is, when the market is expensive going into a crisis, the damage is worse. Valuations don't cushion the fall, they amplify it. Then we get to 2020 and 2021. The Buffett Indicator went parabolic. Stimulus checks, zero interest rates, people stuck at home trading on Robinhood. By late 2021, the ratio hit 200%. Everyone said it was different this time because the Fed had your back, because technology was accelerating, because remote work and digital transformation meant earnings could grow faster than ever. And then 2022 happened. The Fed started hiking rates, inflation spiked, the S&P dropped 25%, the Nasdaq dropped 33%. Growth stocks got obliterated. Cathie Wood's ARKK. Innovation. ETF lost 77% from peak to trough. It was a valuation reset. Plain and simple, the market had gotten too expensive, and when the macro backdrop shifted, there was no floor under prices. Now, here we are again. I pulled the latest data before recording this, and the Buffett Indicator is sitting right around 200%. Some models have it at 207% depending on how you calculate total market cap. Either way, it's back at the same level that preceded the 2022 bear market. It's higher than it was before 2008. The only time it's ever been higher was the absolute peak of the dot-com bubble. So when people ask me if the market is expensive right now, I don't need to guess. The data is screaming yes. But here's what makes this moment different from 2000 or even 2021. It's not like every stock is overvalued. When I look under the hood, what's driving this indicator to these extremes is not broad-based speculation. It's an incredibly narrow group of stocks. And that concentration is something we haven't seen at this level before. That's what we need to talk about next, because if you own an S&P 500 index fund, you need to understand that you're not really buying 500 stocks equally. You're making a massive bet on 7 companies. And those 7 companies are now responsible for holding up the entire index. Let me pull up a chart that should make every index fund investor stop and think. The top 7 companies in the S&P 500 right now account for roughly 30% of the entire index's market capitalization. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. 7 companies out of 500, 3 out of every $10 in the index is sitting in those names. If you go back and look at the weight of the top 7 stocks in 1990, it was around 12%. In 2000, right at the peak of the dot-com bubble, it got up to about 18%. Today, we're at 30%. This is not normal. This is not how a healthy, diversified market is supposed to look. Now, let me show you why this matters for the Buffett Indicator specifically. If the total US stock market is valued at 200% of GDP, but 30% of the value is concentrated in 7 companies, you have a situation where the entire market's valuation is being held up by whether those 7 companies can justify their current prices. And when I look at the valuations on these names, they're not cheap. Nvidia is trading at roughly 50 times earnings even after the pullback. Tesla is over 40 times. Amazon and Google are in the low 20s on a price-to-earnings basis, which sounds reasonable until you remember these are trillion-dollar companies that have to find ways to grow into those multiples. Microsoft and Apple are both above 30 times earnings. These are not value stocks. These are priced for perfection growth stories. Here's the risk that keeps me up at night. If you own an S&P 500 index fund, which millions of people do through their 401k, you think you're diversified. You think you own 500 companies across 11 sectors. But in reality, your returns are now almost entirely dependent on what happens to 7 stocks. If Nvidia misses earnings by 5%, that doesn't just hurt Nvidia shareholders. It drags down the entire index because Nvidia is nearly 6% of the S&P by itself. If Tesla cuts guidance, if Meta's ad revenue growth slows, if Apple's iPhone sales disappoint, you feel it across your whole portfolio, even if the other 493 stocks are doing fine. And we've seen this exact setup before. I want to take you back to 1999 because the parallels are striking. Back then, everyone was talking about the 4 horsemen: Cisco, Intel, Microsoft, and Oracle. These were the untouchable stocks, the companies that were going to dominate the internet age. And they were right about the internet. The internet did change everything. E-commerce, cloud computing, digital communication, all of it happened. The technology was real, the business models were real, but the valuations were not sustainable. Cisco peaked at a market cap of $555 billion in March of 2000. At that peak, it was trading at over 100 times earnings. People justified it by saying Cisco was building the backbone of the internet. Every company needed routers and switches. The growth was inevitable, and then the stock dropped 86% over the next 2 years. It went from $555 billion to under $80 billion in market cap. The company didn't go bankrupt. The earnings didn't disappear, but the valuation reset, and it reset hard. Cisco didn't get back to its 2000 market cap until 2024. That's 24 years of dead money. If you bought at the peak and held, you went nearly a quarter century just to break even. Intel had a similar story. Peaked at $500 billion in market cap, dropped 80%, took over 2 decades to recover. Microsoft dropped 65% from its 2000 high and didn't make a new high for 15 years. Oracle lost 80%. These were not speculative junk companies. These were the blue chips, the safest names in tech, and they all got destroyed because the valuations had detached from reality. Now, I look at today and I see Nvidia trading at a $3 trillion market cap. I see Tesla worth more than the next 10 car companies combined. I see Apple valued at $3.5 trillion, which is larger than the entire GDP of the United Kingdom. And I hear the same arguments I heard in 1999. This time is different. AI is going to change everything. These companies have moats. They're generating real cash flow. And I don't disagree with any of that. AI is real. These are great companies. But great companies can still be overvalued. Cisco was a great company in 2000. It's still a great company today. But if you bought it at the peak, you lost almost all your money and waited 2 decades to recover. The difference between a good company and a good investment is the price you pay. And right now, the price we're paying for these 7 mega cap stocks is baking in decades of flawless execution. Nvidia has to keep dominating AI chips. Tesla has to become the leader in autonomous driving and energy storage. Apple has to keep selling iPhones at premium prices in a saturated market. Google has to fend off competition in search and win in AI. Meta has to keep growing users and ad revenue. Amazon has to maintain its dominance in e-commerce and cloud. Microsoft has to keep growing Azure at 30% a year. If all of that happens, maybe these valuations make sense. Because the market has stayed expensive for a while now, and it's not like smart investors don't see these numbers, so there has to be something holding it up. Let me walk through the bull case because it's a real one, and ignoring it would be intellectually dishonest. The first argument, and it's probably the strongest one, is that these companies are not expensive for no reason. They are generating absolutely massive cash flows. Apple printed over $99 billion in free cash flow last year. Microsoft is approaching $90 billion. Google is over $70 billion. These are not speculative growth stocks with no earnings. These are cash machines. Nvidia's free cash flow went from around $5 billion a few years ago to over $50 billion now because of the AI boom. These are real businesses with real profits, and as long as those profits keep growing, the argument goes, the valuations can grow into themselves over time without needing a crash to reset prices. And there's historical precedent for that. Amazon in the early 2000s was trading at what looked like an insane valuation. People said it was overpriced. People said it would crash. And it did pull back during the dot-com bust. But if you held through that, the earnings eventually caught up to the valuation and then kept going. The money flows to where the liquidity is best, and that creates a self-reinforcing cycle where these stocks stay bid even if the valuations look stretched. Then there's the narrative argument, and narratives matter more than people think. Right now, the narrative around AI is incredibly powerful. Companies are spending hundreds of billions of dollars building out AI infrastructure. Nvidia is selling every GPU it can make. Microsoft is embedding AI into every product. Google is racing to catch up. The belief is that we are in the early innings of a multi-decade technology shift that is going to be bigger than the internet, bigger than mobile, bigger than cloud. And if that's true, if AI really does transform every industry and create trillions of dollars in economic value, then maybe paying 50 times earnings for Nvidia isn't crazy. Maybe it's actually reasonable if Nvidia is going to be the arms dealer for the entire AI revolution. I'm not saying I buy that argument at these prices, but I understand it. And more importantly, a lot of investors and a lot of institutions believe it. As long as that narrative holds, as long as people believe the AI story is real and these companies are the picks and shovels, the stocks can stay elevated. Narratives can carry markets a lot further than fundamentals suggest they should go. We saw that in the dot-com bubble. We saw it in the housing bubble. We're seeing it now with AI. The narrative doesn't have to be wrong for the market to stay up. It just has to stay intact. And here's the other thing that's keeping this market propped up. There is no obvious catalyst for a sell-off right now. The economy is not in recession. Unemployment is still below 4%. Consumer spending is holding up. Corporate earnings, at least for the mega caps, are still growing. The Fed is not in crisis mode. There's no Lehman Brothers moment. There's no COVID lockdown. There's no clear external shock that would force a repricing. And in the absence of a catalyst, momentum can keep carrying prices higher, even if the setup looks fragile on paper. Markets don't top because they're expensive. They top because something breaks. In 2000, it was the realization that internet companies with no profits were never going to make money. In 2008, it was Lehman and the credit crisis. In 2020, it was a global pandemic. In 2022, it was the Fed hiking into inflation. Right now, there's no obvious break. So even if the Buffett indicator is flashing red, even if concentration risk is extreme, the market can keep grinding higher until something forces it to stop. It might mean holding more cash or more short-term treasury bills than you would in a cheaper market. The point is not to abandon equities. The point is that when the market is this expensive and this concentrated, the cost of being wrong is high, and diversification is your hedge against that cost. And finally, this is educational content. I am walking through how I think about this setup. I am showing you the data. I am giving you the historical context, but I am not telling you what to do with your specific portfolio because that depends on your time horizon, your risk tolerance, your tax situation, your income needs, and a dozen other factors I do not know. If you are making allocation decisions based on this kind of analysis, you need to talk to a licensed financial advisor who can look at your full financial picture and help you build a plan that fits your specific situation. The market can stay expensive longer than you think. We have seen that over and over again. Valuations can stay elevated for years if the narrative holds and the liquidity stays abundant, but the market cannot stay expensive forever. At some point, prices have to reconnect with underlying economic reality. The Buffett indicator is flashing a warning that has only shown up twice before in the last 30 years, and both times it did not end well for people who bought at the top. That does not mean you panic. It does not mean you sell everything. It means you pay attention. It means you manage risk. It means you do not let the headline gains in a handful of stocks convince you that the rules of valuation have changed because they have not.